You're listening to AM Now, an Accounting Matters podcast. I'm Adam Olsen.
And I'm Nicole Harger.
We're happily kicking things off this week with some updates from some of the recent FASB board meetings. They met earlier this month to continue their discussions on the accounting for government grants. The board deliberated on possible directions for the project and opted to utilize the accounting framework outlined in IAS 20 concerning government grants. Additionally, they agreed to incorporate specific enhancements to the guidance, drawing from prior board resolutions regarding scope and recognition thresholds. Moreover, the board resolved to offer restricted implementation advice, concentrating on aspects that diverge from the criteria outlined in IAS 20, particularly with regard to scope.
In their second board meeting in April, the FASB kicked the meeting off with discussions surrounding ASC 815, derivatives, and hedging. Specifically, the board decided to replace the existing evaluation method with a fair value assessment. This new approach entails scrutinizing how each underlying factor influences the contract's fair value, pinpointing the predominant underlying element. Additionally, the FASB determined that this assessment should occur solely at contract inception, streamlining the evaluation process. Moreover, the board addressed accounting considerations regarding the grantee of a share-based payment in a contract with a customer, outlining clarifications and illustrative guidance under ASC 606. Transition requirements were discussed, with the modified retrospective transition approach mandated for the accounting of share-based payments and a prospective transition approach for other amendments accompanied by early adoption provisions and a comprehensive benefit cost analysis.
And as a result of their discussions, the FASB set forth a series of refinements and clarifications aiming to enhance accounting practices and ensure alignment with evolving business landscapes. They directed their staff to draft a proposed accounting standard update for stakeholder feedback, including a 90-day comment period. These proposed adjustments underscore the FASB's commitment to fostering transparency, consistency, and efficacy in financial reporting practices, ultimately serving to bolster the integrity and reliability of financial statements across diverse industries.
The board also hit on another topic of ASC 815, which is hedge accounting. Specifically, the board focused on refining risk assessment protocols for cash flow hedges based on comment letters received regarding the 2019 proposed ASU. In response to the feedback, the FASB made significant decisions aimed at bolstering risk assessment practices. They affirmed the proposed amendments to broaden the scope of hedge risk permitted for aggregation and cash flow hedges, removing the same index example and transitioning from the term shared to similar in assessing risk exposure thresholds. Moreover, the board endorsed the requirement for a similar risk assessment to be conducted both at hedge inception and on an ongoing basis, ensuring continuous monitoring and evaluation of risk factors.
Additionally, the FASB amended guidance on assessing the risk exposure of individual forecasted transactions in cash flow hedges. The adjustments included aligning quantitative thresholds with highly effective criteria, permitting entities to conclude similarity in risk exposure if hedging instruments are highly effective against each risk within a group, and allowing ongoing qualitative assessments on a hedge-by-hedge basis. These decisions underscore the FASB's commitment to refining hedge accounting standards, which they've done a lot of, promoting clarity and facilitating more effective risk management practices within the financial reporting landscape.
The board wrapped up their meeting by continuing redeliberations on the 2021 proposed ASU on interim reporting disclosure requirements. Key decisions included referencing going concern evaluation guidance, excluding instructional paragraphs from interim disclosures, and clarifying requirements for disclosures related to debt securities under Topic 320. Additionally, they provided clarity on interim financial statements for non-for-profit entities, specifying presentation requirements for net assets and expenses. The board also agreed to incorporate clarifying language from a previous update on disclosure improvements and decided against including entity scope information in interim disclosures. After considering feedback and drafting improvements, the FASB opted to issue a revised proposed ASU within a 90-day comment period, affirming prospective application for the transition method. They concluded that the expected benefits of the amendments justified the associated costs and directed staff to prepare a proposed update for a vote by written ballot.
Been a long time coming on that one.
Yeah.
So shifting gears real quickly to the news from the SEC, there's been an adoption of amendments to a rule under the Investment Advisors Act of 1940. These changes aim to exempt specific investment advisors known as Internet investment advisors from the Commission's registration prohibition. Additionally, related amendments to Form ADV have been introduced. The goal here is to modernize the rule's conditions, considering the advancements in technology and the investment advisory sector since its inception back in 2002. The effective date for this new rule is 90 days after the date of publication in the Federal Register.
And we're wrapping things up on the sustainability front with an update out of the EU. The European Council has officially adopted the revised Energy Performance Buildings Directive with the aim of reducing energy consumption and emissions from buildings across the EU. Key targets include achieving zero emissions for all new buildings by 2030 and phasing out fossil fuels in building heating systems by 2040. Buildings account for a significant portion of energy consumption and greenhouse gas emissions in the EU, making them a crucial focus for environmental efforts. The updated legislation mandates member states to incorporate these rules into national legislation within 2 years.
And that rounds us out for this week. For a deeper dive into what's trending in accounting, finance, and sustainability reporting, check out our other podcasts on the Accounting Matters feed on your preferred listening platform.
And also, real quickly before we wrap, I want to give a quick shout out to Embark's 13-week cash flow forecast model. You can think of this template as an x-ray into your company's operations, providing important decision-making insights for senior management.
Yeah, and if you want to check that out, we've included a link in our show notes, so take a look at that. So again, I'm Adam Olsen.
And I'm Nicole Harger.
From your friends at Embark, thanks for listening to AM Now. Stay happy, and we'll catch you next week.